Everyone thinks credit unions are just smaller banks. They're not, they're owned by the people borrowing the money. Here's where the money actually goes. When you deposit cash at a traditional bank, you're a customer. The bank owns the building, the servers, the brand. They take your deposit, lend it out at a higher rate, pocket the spread, and send shareholders a dividend check. And here's the trick. The bank's incentive is to maximize profit for owners, not necessarily to serve you well. A credit union flips this entirely. Exhibit 1, you're not a customer, you're a member owner. When you join, you buy a share, usually between $5 and $25. That share makes you part of the cooperative. Every deposit, every loan, every fee, it all flows through a structure designed to return profits to members, not external shareholders. Exhibit 2, the lending math. Banks loan out deposits and keep the margin. Credit unions do the same thing, but the surplus goes into a reserve fund, then back to members as lower loan rates, higher savings rates, or refunded fees. A bank might charge $35 for an overdraft. Many credit unions charge $15 or nothing. The difference isn't charity, it's ownership structure. Exhibit 3, governance. A bank's board answers to shareholders. A credit union's board is elected by members, people who actually use the service. This isn't theoretical. It means a credit union board member might be your neighbor, accountable to you at annual meetings, not to Wall Street analysts. The size constraint is real. Credit unions typically serve a defined community, a geographic area, an employer, a profession. Banks scale nationally. That limitation exists because credit unions need member accountability. You can't have 1 million owners voting on policy. It's structurally impossible. So the claim holds, credit unions and banks aren't just different sizes of the same thing. They're fundamentally different ownership models. One extracts profit for shareholders. One returns surplus to member owners. The structure determines everything: fees, rates, who sits on the board, where the money flows. Neither model is inherently superior. That depends on what you value. But the mechanics are transparent once you trace the cash. Banks consolidate wealth for shareholders. Credit unions distribute it to members. That's not an opinion, that's accounting. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe so you don't miss the next breakdown of how money actually moves through the systems we use every day. This video is for educational and informational purposes only and is not financial advice. Always do your own research.